Welcome, everybody, to another episode of the AgView Pitch. We're heading into a new marketing week. We're already to the second week of December. This week, we're going to be talking about going through the 9th to the 13th, looking ahead. Today, we have with us Duane Lowry. Duane, how's it going?
Good, Chris. Glad to be here.
Good to have you. It's been a little while. We need to catch up here sometime and kind of see what's going on in the world. But there is a lot of things going on in the world geopolitically, a new administration, lots of stuff going on across the world, and then everything from some strength in the corn market to just a lot of question marks when it comes to profitability and stuff. So I think we have a lot of things we can hit on today. But I want to start out with this week. We have the monthly supply and demand USDA report coming out on Tuesday. Some people listen to this before and some after, but any thoughts on that in terms of what, we're not expecting much, we're expecting something. What's your 2 cents on that report?
We might find a lower corn carryout on improved demand prospects. I doubt if there'll be much of a change on the soybeans. Um, uh, I'm not sure that there's anything to be expected that'll be a large market mover, but that's probably the trend that we'll be going with is a little bit smaller corn carryout. And I think it's important to point out last month when they lowered the bean production by just under 1.5 bushels an acre. Um, and while the stocks carryout went down, the total usage went down also. So the full reduction in supplies from the production and the yield change didn't get translated to the bottom line. And I think that's somewhat troubling. And um, the South American weather situation so far is, everything's good enough, and without a problem down there, it's difficult to find the fundamental narrative that really gives us a driving higher type of mentality. Not to say that the calendar doesn't still allow for a problem to develop there. And there have been different times that the longer range maps have suggested there might be a problem develop again. But so far, we don't really have that
Hmm.
problem.
It seems like, you know, it's kind of the tug of war between, that a little bit. And then, we've had, seems like really good demand for corn. Hit on that for a minute. I mean, do you think that demand is kind of front loaded? Is that something that you think will continue? I mean, most of it, I think, has been Mexico. I'll have you touch on that. But is it something that, maybe we, need to, well, let me back up and just say there's a lot of grain unsold, and I think you're aware of that too. There's a lot of corn guys are sitting on trying to decide, do I sell some of this or a bunch of this before the year end, or or do we hold on and hope for a little higher price? And there's probably some downside risk that we have to consider too. Thoughts on corn specifically?
Well, demand has been good. Um, Total export numbers are projected for the current marketing year are up from last year slightly. They're up quite a bit from the year before that. The ethanol demand is projected to be up uh, a little bit, and there might be an increase in that projection here in Tuesday's report. But at the end of the day, you're sitting here at 1.9 billion bushel carryout, and that's higher than we've been the last few years. Um, it is not as high as it was projected to have been maybe a year ago or at different times during the growing season this past year. Um, but at the end of the day, the demand might be a little bit front loaded, and the selling pressures may yet to come on the farmer end. But the overall supply situation and the overall market action has been a market that appears to be well supplied. To the extent it's not well supplied, to the extent that the farmer has seen an increase in his prices, this has largely come about from basis strength. There's been pushes in bids, at different times throughout harvest and the post-harvest period. The corn spreads have tightened, like Dece 24 versus July 25 is probably tightened about 20 cents. The July 25 versus um, well, let's just leave that for later. But the corn spreads are probably tightened at least 20 cents. But what does that mean? That we had plenty of carry in the market, and the market is not earning its carry. The futures market has largely been in a sideways pattern in most of the time a very narrow range with certain brief periods of an upshot and then followed by a decline. But basically, today's price in March futures was first seen at the end of June, and the range that we've been in has probably been, for the most part, a 20-cent range, with the amount of time spent outside of that 20-cent range, either to the upside side or to the downside, has been a limited number of days. And it can be argued that we are currently at the top part of that 20-cent range. But I think the overall market structure, with the spreads tightening, um, and the market not earning its carry and in a relatively small trading range, is a sign that, we kind of have a ceiling on prices. We have a lid. And if one was to argue which market is more justified to go up without a South American production problem, I can understand an argument that it might be corn, but I'm concerned that we will see increased sales before we get to the end of the year or shortly thereafter. And I think that the current cash bids, while not the price levels that people want, um, I think there is some fear amongst the producer that they might not get a whole lot better. So I'm tending to think that we have a little bit of a price ceiling environment here. And there might be other reasons that the market experiences, some weakness in front of us. And maybe the cash corn market can maintain these levels or revisit these levels again if we get a sell-off. But at the end of the day, your cost of carrying that inventory just on the interest alone is probably approaching, 3 cents a month. And I think that to imagine a price rally rewards you significantly for storing that right now, it's kind of difficult to imagine. And I think to get to something that does reward you in a big way, you almost have to get to a point where you're going to have a production problem during the summer, because we're set up to have a marketplace that'll talk about a narrative where corn acres are going to be up this in 25. And I would think that we're up by a minimum of 3 million acres from this past year, maybe more. And that's going to come with it a depressing narrative for these 25 levels. It might not be depressing for the old crop levels, and it might allow the spreads to tighten more. But that, again, is a market that's not going to earn carry. And those tend to have price ceilings. And I'm not sure that our cash market price ceiling isn't very far away from where levels that we're at. So I'm a little bit concerned that the rally that we saw this week, which in essence was kind of a recovery of the days before that, and we're right current levels, we're still 5 to 10 cents off the peak of the futures market at different times in October and November. And I would say that getting above those peaks will be difficult. So let's say that the price ceiling is 10 cents away from where we're at.
Hmm. I think one of the challenges too is just going to be before the end of the year for those that need to be moving grain before the end of the year is going to be a real tough thing too. Just logistically, there is a wall of corn big time, and whether it's before the end of the year or if it's, whatever it is, it's going to be a wall of corn, and obviously I think that's a huge impact, both logistically, both on, also on basis and also on on flat price. So there's a lot of pressure, it looks like to me, with that kind of wet blanket of all the bushels.
Yeah, which again, I think leaves us with a kind of a price ceiling scenario.
Mm.
And I think it needs to be pointed out that um, if your depiction of this wall of corn is accurate, even if, um, well, let's say we find a different reason for the ag markets to weaken over the next several weeks, let's say. that might allow some of those bushels that the farmer had hoped he could sell after, shortly after the first of the year. They may elect to wait because they don't like the price. But only all that does is allow spreads to tighten more. It allows basis to tighten again, and maybe he can attain these cash price levels again that he's offered, say, today. But that doesn't really set the stage for a price rally
Right.
that goes much beyond the cost of money. So um, I I don't want to sound super bearish, but I find it
Yeah.
difficult to craft a bullish narrative here.
I think it's just the message is be cautious. And I mean, people can leave the top side open too, if they're so certain that it's going to go up. But I echo what you say, what we're seeing with our clients that we've been starting to work with. And the market always talks about carry in the market, but there's also cost of carry in the market. That's an individual line item, to your point, interest rates, but there's also other factors in there too, of timing of cash flow and all these other things. And the banks are going to be really critical, I think, of a lot of operations too. So there's just gonna be a lot of things to watch. I want to hit on soybeans, kind of the same mantra here for a second. And I don't want to stay bleak forever here. We'll talk about 25 in a minute, but the soybean side of things, obviously demand isn't there. But on the same token, we don't have a wall of soybeans, at least from my perspective, from what I see, at least from the clients that we work with. And I would gather a lot of people that are listening to this podcast are probably not sitting on a lot of inventory. So is that a helpful piece? Is that enough to make any difference? Or do you think it's going to be the other way because it just looks and feels like there's not that many beans out there, but on the same token, nobody's buying them either.
Well, here again, there has been carry in the marketplace, and the market is eroding that carry. And to the extent that you're correct that the supply out there maybe isn't that much in the farmer's hands, um, that's something that will be handled with spreads and basis. And at the end of the day, you've got, just under 500 million bushels of excess supplies nobody's going to want at the end of this year. And so far, we're on track to have a uh, very plentiful South American supply, which will probably hurt the demand for U.S. supplies going forward. And we run the risk that some of the sales that we've made in beans could end up being switched to South American supplies down the road once their harvest becomes more confident, more known, and those the global cash prices structure in a way that maybe South American becomes the preferred origin. Um, Again, it's very difficult to craft a bullish narrative on beans without a South American weather problem, which at the present time does not yet exist. It is true that we're going to have fewer acres of beans next year based on a lot of different reasons that the farmer is dealing with when he looks at cash flow. But um, if the soybean yield were to bump back up to, say, 53, which is what was projected for this year in October, um, you're talking about a situation where you can lose 3 million acres of soybeans versus this past year and still end up with a carryout around 500 million. Um, so again, it's very, very troubling. I think there are other factors here that we run the risk of getting a downshot in futures prices, probably more related to soybeans than corn. Um, but again, I'm struggling to find the upside narrative at the
Mhm.
present time.
Yeah. I want to shift gears for a minute and then we'll talk on 25 and then we'll wrap it up. But um, we have a new administration. There's two sides of the argument. I was at a couple of several farm meetings with a bunch of farmers this past week, and there's a couple of different camps. Most people are, and I don't want to get political here because I don't have time to get a bunch of hate mail in my email box. We're busy, but on the same token, there's kind of two camps. There's those that are really against the tariffs and they really think it's going to hurt the farmers. And then there are those who say, we got to get rid of the corruption. We got to fix that stuff. And it's not just corruption internally in house domestically, but it's the trade imbalances and all these things, and we got to fix it, and we got to pay the price to get it fixed. Um, if the tariffs come back in, because we've kind of continued with the original, tariff scenario that he set up, the Biden administration didn't really change a lot. What's your take in terms of the impact on, and we'll talk commodities here, but does your crystal ball say, that this is really going to be impactful on pricing, or are you cautiously optimistic, or are you just kind of going to sit on the fence here for a bit? What's kind of your thoughts or your take on this administration and tariffs and all this?
Well, let's skip over the merit of the tariff itself, pro or con, and focus on what Trump is about. I think that Trump is using tariff as a leverage, and um, when he threatened Canada and he threatened Mexico with tariffs, if they didn't close down the border and do things associated with that, man, he got an instantaneous response, and he got Trudeau to fly down to Florida unannounced. He got Mexico to president to be very upset, but at the end of the day, also make concessions and pledges to take care of the border. So he threatens these tariffs. He gets what he wants, and um, we'll see how whether it actually unfolds in either of those two cases. I think it's also important to remember what happened with Trump's in China, and um, he threatened the tariffs. He imposed the tariffs. What was China's response? Did they put on tariffs? Did they do retaliatory action? Maybe some token things, but not in any large way. What they did do is they agreed to buy a large chunk of agricultural supplies from the U.S. And then COVID hit, and they were on track to meet those goals. So, to the extent that we have tariffs again on China, and you're correct. The Biden administration did little to lift them. To the extent that there's anything tougher, it might be for leverage purposes, number one, and number two, China's response might be to make some sort of concessions in terms of agricultural producers, like they or purchases, like they did before. Um, I think that it's possible that the marketplace has a period of time where we trade tariffs, and that's there's a very reaction to that as we get closer to um, Trump's inauguration, et cetera. But to a large extent, I think the market has kind of digested that and traded it. But that's not to say that we won't have a window of time where we get negative price reaction off of that. But overall, I'm really not concerned about whatever happens with tariffs having a big influence on ag prices going forward from the price levels we've already visited at some point during the last, several weeks. So I'm not overly concerned about that. Um,
It seems like we saw this movie before too. It's kind of like it's the repeat of, we saw part one. Now we're going to see part two, and it always seems like part two is just kind of the same thing over again. And you wonder. I mean, we've kind of seen what he did, and if there is an impact on farmers, and I tell everybody when we're doing budgets and stuff, let's not plan on any ad hoc money or any market facilitation stuff or any of those kind of things. But on the same token, I think, even though he's a one-term president now, I don't think he wants to piss off the farmer too bad. And it'll be like you said, it'll be interesting to see how this all shakes out too. But um, I'm optimistic, I guess, and so maybe I'm too optimistic, but I still think this will all shake out okay and be just fine for the producer. It's just sometimes when it's the darkest, it's going to start getting light again, and I think there's a lot of threats out there, but I think there's a lot of positive things too going into 2025. Any final comments on that? And then I want to hit 25 for a minute here too.
I had this discussion with a farmer about the tariffs and about the possibility of the farmer getting a subsidy from Trump. I would caution that um, I don't think Trump has near the incentive to put monies
Get
in the
votes.
farmers' hands as he did the first go around.
Yeah.
And so I think that's the first thing to say. Second thing is, um, I think the environment of putting money into farmers' hands might still facilitate some payment if we get a bad tariff response. Uh, but at the same time, you've got uh, a strong and new effort through Vivek Ramaswamy and Elon Musk and that DOGE uh, effort to cut costs. The environment for spending money on new money and subsidies may not be conducive to a large payment. So I won't say that you couldn't get a farmer subsidy because the banking industry would probably be pushing for it. But I don't think it'll come quite as easy, nor will it be as lucrative, maybe as has been in other times. So I guess that's would be the last. I would throw some caution on that. I think you make marketing decisions on trying to survive with decisions within your own
Mhm.
control, as opposed to betting on something from the government. And there's a possibility that this whole tariff uh, discussion goes through without a major market reaction. And if you
Mhm.
don't get the major market reaction, I don't think you can get the environment for the
Right.
subsidy. If you
Yeah.
if you want to put all your marbles on betting on a subsidy and you want that big subsidy, then whether you know it or not, you're also betting and hoping for a big dump in the market because that's what it's going to take to get the subsidy.
Yeah. The other thing I would say, just as an observation, literally 27 years of looking at cash flows and budgets, it always seems like every time we get in a trough or we get into where there's this ad hoc money, it kind of goes right through the farmers, goes into their left hand and into their right hand and right back out to everybody else anyway. And the farmer keeps a small percentage of it because, rents, uh, all of your other inputs seem like, and you create this sort of short term inflationary impact, at least from what I see anyway. So I'm not sure that it's kind of like a sugar high for a little bit. It feels good when it shows up, but then you end up only keeping a little bit of it anyway. But I guess time will tell, but I just thought that'd be interesting to hit on that for a minute. So
While you haven't asked this question specifically, this discussion seems appropriate to give this
good,
answer.
good.
Um, with the cash corn prices where they're at, which is at the upper end of where we've been at any time from the time harvest began, and maybe for several weeks prior to that, um, considering the fact that some people were fortunate to get some very good yields, and their neighbors not that many miles down the road may have been unfortunate and didn't get those good yields. But um, everybody's got to look at their own operation. And if they're able to take these cash prices along with whatever sales they may have made ahead of time before, and maybe they did have some good yields, and that dollar's up and makes it a good survivable year for them, um, they might want to remove the risk of whatever's ahead in terms of tariff or any other concern one might have, and take the approach that we have a price ceiling. We have a difficult time finding a fundamental narrative. And without a South American weather problem or without a summer weather problem in the US, which means you'd have to wait that long to get it, maybe you just take what is offered, close the books on it. And to the extent that you either now or sometime in the future might want to make a bet on a South American weather play or a US summer weather play, then save a few dollars in reserve to find a futures or option strategy to initiate at some point in time in the future to participate that. But
Mm,
I don't think risking what is currently offered is a good bet. I think this rally that we've had in the cash market from the lows that we've seen from throughout harvest, um, and there might be better basis opportunities ahead. I could see that scenario. There might be some slightly better cash market prices ahead, but I think this is we need to be in survival mode. And I think for many producers that did get some nice yields, some favorable yields, maybe even some excessively large yields, they can do that. And maybe that's all one should expect.
yeah, it seems like a person too, we've talked about this. I know you and I have talked about this. The day to make the cash sale isn't always the same day that you want to lock basis. And it kind of feels like, I mean, throw a dart at this if you think I'm wrong, but it feels like, maybe if we get a rally in this week, for example, and a person decides to make a sale and logistically they can't get it moved or don't want to move it in this year, but they could price it on the May or whatever, and then not lock basis, that, like you said, there could be an opportunity out there, or price it for the, and those are bushels that sometimes can go during planting season or whatever, and you can capture that, add that basis to it. Conversely, the other side of it, and I want to get your take on this real quick. If a person sets basis because basis is good and the price gets away from you, that was a lesson that I think a bunch of people learned the hard way last year too. Any thoughts on, navigating price setting and basis management real quick on that thought perspective?
In the case of the corn, the last thing I would do is set the basis, but not
Right.
set the futures price.
Right.
And many times throughout my 40 some years of being around the cash corn market, many times that has been a trap to do so, and to lock in that basis and then wait on the futures. And
Mm.
a few times has it been the right thing to do. And um, we still have a price structure with futures and spreads that suggest that would be a trap again. So I would not be doing that.
Yeah. Agreed. Good. Well, we agree on that one, I guess. Last thing, Duane, I want to hit on with you is the 25-acre mix. Based on what I'm seeing, and we'll know more from the seed companies. A lot of them are in the process of getting those early orders finished up and things, and we'll get some feedback from some of those people, and we'll have a better idea here in a week or two, of kind of what the orders look like, and that gives us a little insight. But from what I've seen so far is a definite shift to some more corn. Obviously, the majority of the people don't change anything; they just kind of go with their rotation and they don't adjust it. But those who do have made, at least from my perspective, and I'll be smarter in another 2 months probably, but it looks like that shift is to quite a bit more corn. What kind of impact do you see, if any? Because then you hear people saying, well, I'm going to stay the same because beans are going to go up because the bean acres are going to be way down. The problem is we need to sell them too. So any thoughts on 2025, and then we'll wrap it up, but just things that people should be thinking about as they think about selling 2025. Last thing I want to say, throw in there, I'm sorry, I mean this to be a narrative and instead I want it to be a question, but the last thing I want to throw in there is you've got, a lot of people, um, wondering, should they be pricing some stuff on these rallies? Because the problem is for most of our clients, it's in the red, and it's really hard to make sales when you're below your cost of production. And we have very few people that could pull the trigger right now. Probably less than 10% of our clients could pull the trigger right now on the current D's 24 and D's and Nov soybeans, and even be anywhere close to making any money. Thoughts on 25?
Definitely going to see more corn acres. It'll be at least 3 million more, could be more than that. And the impact on that is um, any strength you get in the old crop corn market will be driven by basis and spreads, not futures flat price rally. Um, the DEES 25 futures will be a dog. And if the corn market rallies, and if the futures do happen to rally, DEES 25 will be the weakest part of that component. So if you want to get DEES 25 corn futures back to something that is more palatable, and let's say that is something 450 and beyond, and for the longest time, I was hoping we might get a chance at 470. In October, we got up to, I think, just under or right near 460. And then the best we ever saw in November for DEES 25 futures was 450. We're now sitting under 440. I think that uh, producers, when they look to 25, I agree, it's difficult to make these sales right now. There are scenarios that you can imagine and numbers you can throw out with the extra acres to where people will be talking about sub $4 futures for new crop 25. I'm not sure I totally embrace that, but I understand where it's coming from, and I think that we will have to deal with that narrative and in the price discovery situation in the weeks ahead of us. But I'm reluctant to make sales on D's 25 on anything less than 450 futures. But as you gravitate upwards from 450, if given that opportunity, I think the incentive to make sales before you get to the actual growing season would be quite high. So hopefully we can find some reason to get there. Maybe it'll be a South American weather concern. As far as um, the beans are concerned, um,
Can I throw
you
something
got
in
to get
as you're
you're gonna
thinking about? Can I throw
yeah, go
something
ahead.
in there as you're thinking, coming up with your thought? I was just looking here, and I don't have the exact numbers in front of me, but I think our average client's cost of production on soybeans projected for 25 right now, and this number will change a little bit, but it's like 1176. So, you know, it's pretty bleak looking right now. I just wanted to throw that out
It's
there.
it is bleak, and I think that it's going to stay kind of bleak. And I'm not in favor of making new crop bean sales. And I'm gonna I guess I'm if I'm gonna look at the uh, uh, the 25 and I'm gonna figure out my marketing plans, I'm gonna be hoping for an opportunity where I can get, and it doesn't take, like, you get corn up 15 cents for beef 25 from where it is right now. I'm considering that an opportunity. I'd rather be much more aggressive on my corn sales and then not make any soybean sales. And
Mm-hmm.
that's my marketing strategy. That's my risk management strategy. I'm just more aggressive on taking what I can get on the corn and not so much on the beans.
Mm-hmm.
That's my general approach. There's one other thing that I want to talk about before we wrap up that we haven't touched on, and I consider to be a major threat to agricultural prices. And whether that threat to agricultural prices is in the form of a price ceiling or a price decline, the future will still hold that. But the crude oil market is sitting here at the bottom part of price parameters we've had since 2022. And when Trump gets into office, uh, whether people like it or they don't like it or have different views on the merits of it or not, this Ukraine war is going to come to an end. Middle East is going to come to uh, some sort of an end. And we must recognize that throughout all the Middle East turmoil, throughout all the threat and the what if scenarios about crude oil supplies in that region, the marketplace hasn't responded. And I think we have an overall deflationary environment here that Trump's election is probably going to help fuel. And if this crude oil market takes a dump, and let's say instead of being at 70 to 80 or 70 to 85, which is where we spent most of the last year plus, we're sitting here perched now at under $68 crude, and um, for that market to take a dump to say $50 crude, that is not going to be favorable to any commodity market. And I think that's a very much of a problem. I'm far more concerned about that impact on agricultural prices than I am on tariffs. And so I think that as we move forward over the next, let's just say between now and mid-February, I think there's a good chance the crude oil market's going to take a dump. And I think that as those prices slide, I think the investor environment for owning commodities is not going to be good. And we've already talked about the finding it difficult for a fundamental narrative for the corn and the soybean markets, absent a South American and or a U.S. next summer weather problem. So we have a window of time here for where prices could be depressed and the outlook could be heavy. But I think the crude oil and a general deflationary environment, I think that's the biggest threat that's going to come in with the Trump administration. And I think that is something that could create a problem for the corn and the soybean markets, more specifically the soybean market.
Mm-hmm.
And So I'm very concerned about that. That's also another factor that's motivating me to tell producers to err on trying to find a way to view current cash corn prices as an opportunity to lock in your 24 production scenario and capture a survivable situation.
Well, and if you stuck a fork in the 24 crop, like you said, you're going to be first. Some operations are limiting their losses, and a lot of them, because there's a lot of red ink in the 24 from what we're seeing as well. Um, but it also is, if the market does go back up, we're long. Most all of these guys are long almost 100% of their 25 crop. That's the best thing that could happen is the price does go back up. Last question. You brought up energy, so I'm going to bring up currencies real quick. The dollar's been really strong. Is that another wet blanket too? I mean, does that, because with the Trump administration, you would logically that would tell you we're probably going to have a really strong dollar too, which is a negative for the commodity side of the equation. Any thoughts on that? And then we'll wrap it up.
Well, I think that's part of the reason why the dollar has been strong is the anticipation of a Trump victory.
Right.
Um, as far as being a wet blanket, it's difficult to find any day-to-day connection between and soybean price discovery and the currency markets. It's even difficult to find bigger picture connectivity between those two. Um, it is probably a wet blanket, but to be perfectly honest with you, I'm not sure. I'm not convinced that this strength in the dollar is actually the long-term trend. I'm more inclined to believe that the longer-term trend is that the dollar weakens. And I think the longer-term trend is that a weakening dollar could be something that changes the price landscape in the months ahead of us. So I'm skeptical of the dollar maintaining strength. I understand the reaction to Trump's election or anticipation of the Trump's election. But going forward, I'm not convinced that's going to be sustained. So I think the dollar and the currency price structure, months from now, we might be talking about how that's actually benefiting the ag prices. But so I'm not sharing the longevity and the ability of the dollar to hold the strength that it's had.
Mm-hmm. It'll be interesting, and then definitely, we'll get you back sooner rather than later. But you'll be an interesting one to visit with as we get into the month of February. You've got a lot of a good knowledge and perspective on risk mitigation and understanding the crop insurance and all that kind of stuff. And with that Trump administration, having a month under their belt or a couple months under their belt, we get into that February timeframe. We're going to be a lot smarter then too, in terms of to your point, with energies and currencies and what the funds are thinking and all that stuff. But definitely get you back, a time or so in front of that, and then for sure, when we get to that risk mitigation time frame that we all need to be measuring. I'm gonna give you the last word. Anything you want to leave guys with, and we'll wrap it up.
Um, I guess I'll leave the last word would be I understand that prices aren't good, and I'm talking about focus mostly here on old crop corn. Prices are not good. Um, Profitability depends on how fortunate you were with rains last year and your yield outcome. But even if you didn't get as good a yield as you wanted to on a national scale, we got enough to have a record yield by, multiple bushels per acre. We have a carryout that is still plentiful, and we have to have a production threat to change the needle on the supply influence on prices. Therefore, even if you didn't have a good year and you're not able to make this dollar up, I think the opportunities and the outlook and the expectation that you're going to get that opportunity might seriously be in question. So um, even though you might be taking a loss, you could have a situation that um, a loss smaller than what it might eventually be might still end up being a better deal than sitting here and hoping that prices get better. So
Mm-hmm.
I know I sound pretty bleak here, and I And I am bleak in terms of a price ceiling. That doesn't mean we can't get some ups and downs. What I think overall we're dealing with a price ceiling mode, and the quicker the producer can find rationale to put a fork in it for the 24 crop, I think the better. I think there's going to be a challenge ahead for marketing the 25. And if we have a scenario that the prices can't muster a rally until we get into the summer growing season, um, that's going to be a very heavy emotional burden for everybody to sit through, knowing that these prices for new crop just don't work.
Mm,
And it's possible that we have periods of time between now and next summer where we're dealing with even lower prices for new crop levels than what we have today. And
mhm,
so it's going to be a very difficult emotional ride along with the difficult financial ride that we're going to experience here. And I wish there was something I could point to immediately for something more hopeful in that arena, but I don't see it.
mhm. Yeah, it's going to be interesting at loan renewal time. I think, the banks are going to put a significantly lower number on the balance sheet on unpriced bushels in terms of what the value of that inventory is. And that's going to be a sticker shock, I think, for a lot of producers because the producer walks in with current price levels or whatever on unpriced bushels. The bank's not going to look at it the same way. So I think we're gonna do a lot of this is the time of year to be thankful for what we got, but also to sit down and really crunch the numbers and think about what the next steps are and kind of get 24 sort of wrapped up so that we can start really putting our mind into 25 and what we can do to make 25 a successful year. But hey, Duane, with that said, I think this has been an excellent conversation. You got a ton of really good perspective and things for people to think about, and really appreciate it. We're going to get you back here again, and we'll kind of check in and see how things are going. But really appreciate it. Thanks a lot, Duane.
Hey, Chris, one last thing. I want to
Yep.
put an exclamation point on my energy price narrative that I just laid out. If I
Okay.
happen to be right on this, that is something that's going to happen almost immediately. And that's something that we're going to be feeling uh, in the next 30 days. And that means that producer marketing decisions associated with the end of the year, first of the year type of scenario could be heavily influenced by this. So keep a very close eye on this energy thing. It's looks very troubling to me.
Hmm. Awesome. Well, that's a good action item for us all to pay attention to that is a big piece of the puzzle. With that said, hey, Duane, again, thank you very much. Appreciate it.
Thanks, Chris.
You bet. And thanks everybody for listening too. And if you guys got any topics that you would like us to be hitting on 19 minutes, if you're not listening to 19 minutes, I'd highly recommend you check it out. It's on Spotify. You can look it up. It's $30 a month. We come out the 9th, the 19th, and the 29th of every month. And we got a lot of really good stuff on there. Just going to record the next one. It's going to be called You Are Wearing Too Many Hats. And so a lot of us are pretty busy. And so we're going to have some solutions and some discussion on how to navigate and delegate and keep your business going without burning yourself out. With that said, really appreciate everybody. We'll catch you again next time on the AgView Pitch.